Mortgage rates versus buyer demand. Where to from here? That's what we're going to cover in this monthly market report. This is for you if you are a real estate agent, a financial advisor, or an attorney interested in market data to help you advise a client, or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005, and here is the market data that you need to make an informed buying or selling decision or help your client do the same. So what's happening in the current housing market? I think we can probably all agree that this year is really defined by rising mortgage rates. A lot of this has to do with the moves that the Federal Reserve is making to ease inflation. Remember that inflation is the enemy of long-term interest rates, and that's exactly what the Fed is trying to do. They're trying to control inflation. And as it starts to happen, as we saw in the last Fed meeting, they raised the federal funds rate by 0.75%. And mortgage rates fell as a result of that. That's counterintuitive to some, but the market took that to mean that the Fed is getting inflation under control, hence why mortgage rates fell. Now, as that starts to happen, the fear of recession comes into the conversation, and we're seeing a lot of chatter about this in the media. We're starting to talk about what happens if we're in a recession, and the piece we want to follow is what history shows us about what happens to the housing market during recessionary times, which is very interesting. The question is, are we in a recession? And whether or not we're in a recession right now is really kind of up for debate, and it's become a bit political. So I'm not going to get into that aspect of it, but I will set up the argument for you. The widely held belief is that a recession is 2 consecutive quarters of negative growth in the economy. If you look at this chart here, you can see that going all the way back to the late 40s, every time we've seen 2 consecutive quarters of negative growth, a recession has been called. Now, I don't recommend you get into a debate as to whether or not we are in a recession, but this is definitely the talk that starts to cause fear and concern. The question that we want to be able to answer is, how would a recession impact the housing market? So if we look at what the data says, a recession does not mean falling prices. You may recall the slide from last month, and what it shows is that 4 of the last 6 recessions, home prices actually appreciated in value. Now, we all remember 2008 when home values lost nearly 20%, but that's really a very fundamentally different place than where we are today. The market was drastically different. So what does a recession also mean? A recession also means falling mortgage rates. As we look at the data about what's happened with mortgage rates over the past 6 recessions, rates have declined. That's what you can see here. This is the percentage points decline in mortgage rates over the last 6 recessions from the peak to the trough. So you can see every time mortgage rates have ticked down. So that could be really good news for the housing market. Those buyers who have maybe been paused in the process or stepped out of the home buying process because they've been priced out by high mortgage rates will now have a reason to get back in. So with that in mind, let's talk about another big question that's on everyone's mind, and that is about a housing crash. The housing market will not crash. And the heart of that argument is inventory. This is a look at the total housing inventory registered as at the end of June, which was 1.26 million units. Now, if we look at that from a month supply perspective, unsold inventory today is at a 3-month supply. That's that little green bar that you can see over on the right. Now, compare that to the red bars. That's the oversupply that we had during the housing bubble when the market crashed. That's because we had more homes on the market than we had buyers to buy them. We have the exact opposite problem today, and if you look at this comparatively, where we are today is nowhere near the oversupply we had last time. The typical neutral market is 6 to 7 months of supply of inventory. We don't even have half that at this point. So although we know this number is growing and we know more inventory is coming to the market, we certainly aren't anywhere near what's needed for the housing market to crash. We are still in a seller's market, as you can see in this slide. The inventory line is rising, and that is great news for the housing market, but nowhere near those 2008 to 2010 regions where we truly had an oversupply of homes on the market that caused the housing market to crash. Now, we've talked about mortgage rates, where the housing market is today, and why it won't crash, but one of the big questions on everyone's mind is, what's ahead for the rest of 2022? So let's dive into what experts are saying is ahead for the rest of the year. Those of you that follow these monthly reports that I do are familiar with my dislike of the mainstream media and the misinformation they spread about housing. I'm particularly excited today, however, because I'm going to quote CNBC with a straight face for the first time. But then again, their quote was a quote from the Mortgage Bankers Association. So I don't know if that counts, but here it is anyway. There could be a potential silver lining for the market as stabilizing mortgage rates and rising inventory may bring some buyers back to the market during the second half of the year. So great news for buyers. We certainly do hope it's true that mortgage rates hold steady, and if they do, with home sales softening just a bit and prices projected to continue rising at a moderate rate in most markets, what does this all mean? Well, here's a great visual to share with your clients. 3 reasons to buy a home today. There are 3 things that are happening right now that are creating a great scenario for your buyers, and it's our job to get this message out to them. We're seeing fewer multiple offer scenarios. You can see in April, the average home sold had 5.5 offers that ticked down to 4.2 in May and 3.4 in June. That is a trend that we are going to see going forward. There are also fewer homes selling above asking price. You can see that percentage has ticked down from 61 to 51%. But don't get me wrong, still a very competitive market if over half of homes are selling over asking price. But it is a better time for buyers to jump in if they're ready to find a home, since the supply of homes for sale is growing. You can see that inventory, that month's supply, ticking up as the pace of home sales slow and more homes come to market. So certainly not easy to find a home right now. There's no doubt it's still very competitive, but definitely not as impossible as it may have felt for those who probably stepped out of the process last year or at the beginning of this year. So as we wrap up, the 3 things we went over were mortgage rates, why the market won't crash, and what's ahead for the rest of the year. We want to ease our clients and prospects' fears, help them understand what history tells us, and we want to lead them effectively to help them make powerful and confident decisions so they can jump into the market when they're ready and can make those decisions based on what the data is telling us. There's a lot of fear, a lot of concern out there, and the data can help change that story for us and our clients. That's a wrap for the August monthly market report. I appreciate you listening in. Forward, subscribe, share. I'll be back next month, but before you go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, please feel free to reach out, and I'll be happy to analyze if your debt is structured in the most optimal way or if there is room for improvement. Thanks again for watching. Bye for now.